How the rich avoid taxes legally. Have you ever wondered why Warren Buffett pays a lower percentage in taxes than his assistant? Or how Jeff Bezos paid 0 in individual income tax 1 year while his workers paid thousands? As someone once said, in our world, there are 2 types of people. Those who pay taxes and those who don't. And most of us fall into the first category. But not the rich. They avoid taxes legally. And we can do it too. We live in a time where despite record inflation and a looming recession, the ultra-wealthy continue to thrive and multiply their wealth. In 2020, Forbes reported that the world's richest people gained $4.6 trillion during the pandemic, while the bottom 99% lost nearly $3 trillion. So how is it that they managed to grow their wealth so fast and pay such low taxes? Well, here's the secret truth. The truth is that billionaires don't pay taxes on their billions. They only pay taxes on the income that they take from their billions. And what they've done throughout history is to find loopholes around paying taxes on the billions themselves. I will tell you 7 ways the rich avoid paying taxes. Before we start, please subscribe and support me by becoming a member. You get exclusive access to my investment club and can ask me any question. No? 1. They use legal tax loopholes. When you think about rich people, you probably imagine flashy sports cars and huge but in reality, most of the world's wealthiest people got there through investments and business ownership. They leveraged their money to make more money. And since they don't have jobs with regular paychecks, they don't pay taxes at the same rates as you. Instead of salary, they receive capital gains, which are taxed at a lower rate. If you invest in stocks and make $10,000 in profit, you pay long-term capital gains tax. These range from 0 to 20% depending on your income. But if you work hard and get a raise of $10,000, you pay federal income tax on every dollar of it, which is between 12 and 37%. Not fair. Number 2, real estate write-offs. Now, I know this might sound unfair, but real estate investors take advantage of some pretty sweet deductions. Things you can write off against your rental income to reduce your taxable income. Here are some of the most common ones. Depreciation. This is an estimate of how much of your property value is lost due to wear and tear over time. If you own a rental property for 10 years, you can usually depreciate about 2.5% of its value each year. Mortgage interest. You can deduct the interest you pay on your mortgage from your taxable income. Property taxes. You can also deduct the property taxes you pay on your rental property. Repairs and maintenance. Unlike capital expenditures, which increase the value of your property and aren't deductible, you can deduct repairs and maintenance expenses from your taxable income. Insurance premiums. You can also deduct the cost of insurance you pay for your rental property. Other common write-offs include home office expenses. If you run your business from home, you can write off part of your mortgage interest, rent, utilities, and other expenses. Travel expenses. You can deduct travel costs like airfare, hotel bills, and meals if it's for business purposes. 3. Business expenses. Owning a business comes with plenty of perks, including being able to write off certain expenses. The IRS considers these ordinary and necessary business expenses. So, here are some of the most common ones. A new car. You can deduct the full price of a car if you use it for business purposes. However, you may need to reduce the deduction if you use it for personal use. Travel. Just like with business, travel for your rental property. You can also write off travel expenses for your business. Phones. If you have a phone plan for your business, you can deduct the cost of your monthly bill. Number 4. Taxed deferred accounts. One of the biggest advantages of being rich is that you often have more options available to you when it comes to your finances. For example, many wealthy individuals take advantage of tax-deferred accounts like 401 kiloseconds and IRAs to defer or avoid paying taxes altogether. How do they do this? Well, let me explain. First, we have 401k retirement plans. A 401k is a type of retirement savings account that allows you to contribute pre-tax income from your job to an investment account. Contributions to traditional 401k accounts are tax deductible, meaning you won't owe taxes on that money until you withdraw it, and unlike with other accounts, you can borrow from your $401,000 loan without having to pay taxes on it or incurring any penalties. Next, we have IRAs. An IRA is another type of retirement savings account that allows you to contribute up to $6,000 per year and receive tax benefits. There are two main types of IRAs, traditional and Roth. Traditional IRA contributions may be, although whether or not you can take a deduction depends on your income, and whether or not you or your spouse are covered by a workplace retirement plan. With a Roth IRA, you pay taxes on your contributions now, but your withdrawals in retirement will be tax-free. Next, we have trusts. Trusts are arrangements that allow you to put your assets into the hands of a trustee who manages them for the benefit of others, known as beneficiaries. One of the most popular trusts among wealthy individuals is the irrevocable trust. With this type of trust, assets are transferred to the trust and cannot be taken back. This can help you avoid probate court and reduce your estate taxes. And finally, we have life insurance. Life insurance policies can be a good way to save on taxes. Most life insurance policies offer tax-free death benefits, meaning that the money paid out to your beneficiaries will not be subject to income tax. No. 5. They move offshore. Yes, that's right. Many wealthy individuals choose to move to countries with lower tax rates or even set up offshore accounts in tax havens like the Cayman Islands, Monaco, and Switzerland. The Cayman Islands is a popular choice because of its political stability, strong economy, and territorial tax system. This means that the government does not levy taxes on any income earned outside of the country. Monaco is another tax haven that attracts wealthy individuals due to its low tax rates and high standard of living. Switzerland is also known as a tax haven and offers many benefits to wealthy individuals, such as a stable political system and strong banking laws. By moving to these countries or setting up accounts there, the rich can significantly reduce their tax burden. But you might be wondering, should I do the same thing? Well, maybe. It depends on your financial situation and what you want to do with your money. If you're looking to reduce your tax burden, it may be worth considering moving to a tax-friendly country or setting up an offshore account. However, it's important to do your research and make sure you understand the implications before taking any action. So, how exactly do they move offshore? Well, there are a few different ways. One way is to set up a bank account in a tax haven. This can be a good option if you want to keep your money in a safe place and avoid paying taxes on it. Another way is to incorporate a company in a tax-friendly country. This can be a good option if you want to do business internationally, or if you want to protect your personal assets. Finally, you can also buy property in a tax haven. This can be a good option if you want to diversify your real estate holdings, or if you want to have a place to go when you retire. 6. They don't pay tax on the billion. While we were talking about how the rich don't pay taxes on their billions, they only pay taxes on the income they take from their billions. Let me explain this better. Imagine you own a piece of land worth $1 million. 7. They leave the country. This one might sound crazy, but hear me out. More and more people are choosing to leave the United States and move to other countries, especially countries with lower tax rates. Some of the most popular destinations for U.S. expats include Panama, Ecuador, Mexico, and Colombia. According to a survey of wealthy Americans, 21% are thinking about leaving the United States in the next few years. And that makes sense, given that America has one of the highest tax rates in the world. But how do they do it? Well, there are a few different ways. One way is to apply for citizenship in another country. This can be a good option if you want to live and work abroad permanently. Another way is to get a residence permit. This can be a good option if you want to spend part of the year abroad and part of the year in the United States. And finally, you can also buy a vacation home in a tax haven. This can be a good option if you just want to escape the high taxes of the United States for a few weeks each year. So, is it worth it to move abroad or get a residence permit? Well, it depends on your Individual circumstances. If you're willing to give up your US citizenship and move somewhere else permanently, then it can be a great way to reduce your tax burden. However, if you're not willing to do that, then getting a residence permit or buying a vacation home in a tax haven might be a better option for you. Now, these are legal strategies that rich people use to avoid taxes, but that doesn't mean they don't pay taxes. They just pay less. It's time for us to learn these strategies and use them to keep more of our own money. What are your thoughts on this? Do you think the rich should pay more in taxes? Let me know in the comments below. Thank you very much for watching this video.